Here we go. Money talk.
Hello and welcome to the Financial Fitness Bunny Podcast, your number one stop shop to all things money management. Of course, my name is Manqele. I am your host. I'm also known as the Financial Bunny, and I'm here to put lipstick on that money pig. This week, we are doing things very differently. So instead of a book review, I have a guest in studio. So ladies and gents, drum roll, pa, 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 pa. On today's episode of Yes, Money Does Matter, we speak to Nomzamo Manqele, who's an investment specialist at Fedgroup, about the real picture of investing. Now, Nomzamo is an investment specialist. She's also a speaker. And if you really want to understand your needs and to match them up with investment vehicles, then she is the perfect person to speak to. Nomzamo, welcome to Yes, Money Does Matter.
Thank you so much, Nicolette. It's such an honor to be here. I'm super excited. And hello to all the financial bunnies out there.
Yeah, I'm so excited to have you. Guys, I must tell you, Nomzamo and I connected at Can Agri. It is a lettuce farm, right?
Lettuce farm.
An impact farming.
Yes. So it's one of those, it's in Pretoria. Super duper looking. It's like fantastic. You know, it's modern day farming, smart agri. So it's your hydroponics. Yeah. So that's where we met.
I'm also going to have Nomzamo on a YouTube video, so you'll be able to see all of those visuals of what we're talking about. And I think once you actually start seeing how pretty lettuce farming is, you may just think, oh, okay, this is something different. But today we're looking at the real picture of investing. We're talking about whether or not high risk does indeed yield high return, and how can we make it easier for people to invest. And of course, we cannot run away from touching on investment expectations and reality, because I feel that's always where a lot of people trip themselves up, right?
Yeah.
People have a lot of expectation from their investments. They don't sometimes give it enough time. And then they come on social media and we write Facebook posts about, this company said I was going to get this and this didn't happen.
Very
right?
true, yeah. I
mean, you've seen some of those
expectations. And I think it's also, people think investing and they think, I'm going to make big money very quickly.
Yes.
And I think that's where people just get it wrong. So people have unrealistic expectations as well. And I think that's where now it creates the fear around investing, because now you've gone into it expecting something that's unrealistic. And then when you're done, you don't get what you expected. And then you're like, oh no, investing is not for me. And those are the things that create that...
investing doesn't work.
Exactly.
How many people have said investing doesn't work? And I'm always like, what
are you talking about? Yeah, like...
I always say, so I'm from Mpumalanga, obviously, and so are you.
Yes. Mpumalanga girls.
I love it. And I always say, living in Mpumalanga really taught me a great investment principle, because we've got a lot of citrus trees, we've got a lot of, but one of the trees is the avocado tree.
Yeah.
Now, if you have some experience in growing avocados,
they
take
time.
Long.
Like you probably...
Listen, I've never seen a tree take so long to bear fruit.
But it's worth it, right? Because avocados are like proper.
And by the way, our avocados in Mpumalanga are so better than the avocados here in Gauteng. I just can never believe how small the avocados here are.
And how they taste.
Yes!
I was a buttery. They're proper avocados, not these. But let's not disturb. But
you can hit a whole loaf of bread with our avocados. But anyway, let's not digress too much. Let's get into investing. So, what is investing?
I think basically investing is a process in which a person buys an asset.
Yeah.
In the hope that they will get a return or they'll get capital growth. So basically that's what investing is. So it's the process of you purchasing an asset, basically with the hope of getting a return, in terms of getting income from that asset or capital appreciation. Yeah. So that's basically what investing is.
So taking our avocado tree into scenario, it's taking buying a seed.
It's
of
like
an avocado.
buying the seed.
The asset.
That's the asset.
Yes.
Then with planting it.
Yes. That's the investment.
Yeah, that's the process of investing basically. Yes. And then with the hope, so you'd water the tree, obviously the whole sunlight thing growing, but that's with the hope that it will grow. So basically it's taking whatever asset, purchasing it, resources, whatever, with the hope that it grows. So it's always important to also buy assets that appreciate in value.
Yes.
So
essentially the seed is not necessarily the Yeah, okay, well, the seed is kind of the asset. So it's the
yeah.
same way we take money and we buy an asset, right?
Yes.
So we're buying the seed, which is the asset, and then we put it in an investment. Some assets don't need you to actually put them into an investment, but you have to take care of them.
Yeah, you need to take care of them.
And then the sunlight, the watering, that's market conditions, basically.
Yes.
And then when the tree grows and it bears the avocados, that's your return.
Or your capital appreciation.
Love it. I think that's probably the easiest way to explain it. And I think everybody who's listening right now probably now starts understanding what investing is. Okay, now we understand what investing is. When does one start investing?
For me, I think the sooner the better. So as soon as you've got resources, meaning money to invest, it's the better.
Yeah.
Why I say that is that because of the fact that with investing, there's something called the compounding effect, where interest upon interest. So the sooner you start, the longer term, you have a longer horizon. So that means that you've got the potential to grow your investments over time. So that's important, I think. The sooner you start, the better, basically, as well. Yeah.
You just spoke about a horizon.
Yeah.
How important is that? Because I think that's always...
That is critical.
So I think, maybe tell us what it is first. Okay. Yes, and then why it's important.
Yeah. So horizon basically is a time frame of which you've sort of planned to invest for. So I think it's important. One of the most important investment principles is always to have a goal in mind.
Yes.
And after you've established what your goal is, you establish the time. How long will it take you to achieve this goal?
Yes.
And that's what we speak in terms of a horizon. And in terms of the horizon is the most important thing in investments because it allows you to, I'm going to go a bit deep, but it allows you to sort of be able to not, what's the word I'm looking for?
To not
navigate the market, the market as well.
Yes.
And I think if you've got a goal in mind to say, I'm going to invest for the next 7 years.
Yes.
Should in year 2 the markets are down, you understand as an individual that my investment goal is for 7 years. So you can ride out the market, and that's where the compounding effect also comes into play. So you understand that you are able to review your portfolio in time as well during the time horizon, and you don't panic.
Yes.
So it gives you a bit of comfort, also understanding what was the goal initially when I started my investment, and what's the time horizon. And I think that's the most important thing. And with time and in the right asset classes, you are bound to win with investing.
It's so funny you say that because actually my wealth manager, who's a fantastic financial planner, once said to me, a good financial planner is somebody that can help you ride the market.
Yeah.
Fluctuation changes. If the environment changes, they need, as your financial planner, to have already kind of picked up on that and know what to do.
So a good financial advisor is one that sees the change coming before it happens and allocates and moves your portfolio in expectation with what's going to happen. So I think it's important in terms of having a person who's abreast with what's happening in the market, as well as obviously diversifying your portfolio, making sure that you've got a little bit of all the assets within your portfolio, in your basket, so that you can ride the market. So when one stock is down, one asset class is down, you know that you are getting the buffer.
But do you need such high level when you're starting out? Let's say you're in your 20s.
So I think obviously when you're in your 20s, you've got time on your side because you are able to ride out the market. So I'd always, in your 20s, you'll take higher risks.
Yes.
You'll go into asset classes that are seemed to be a bit riskier. I mean, obviously somebody who's in their 60s would not probably be looking at putting a portfolio into equities, cryptocurrencies, exposure to that, because that for them is their safety net. So now so when you're younger, you have an ability to generate income as well. So obviously, when you're older, you are depending on that investment for your income. So as a younger individual, you have the opportunity and the potential to ride out the market. So it's always better to, at a younger age, to invest your portfolio geared up a bit risky. But it's also important to understand your tolerance levels, your risk appetite, because we don't all have the same risk appetite. So once you get into an investment that you feel uncomfortable about in terms of the level of risk, then it means you're in the wrong asset class. So also understand what your goals are, how you feel about investments, because I think the feeling is very important.
I'm glad you started speaking about those asset classes, because what are some of the ones that are available for one to actually consider?
So we've got equities, stocks, bonds, cryptocurrency, what else? Property. So commodities. So there's a lot of asset classes. I mean, there's alternative investments. So people do paintings. So it's very diverse. Hey, I mean, there's a lot of asset classes.
So in essence, anything could essentially be an asset class if it's going to vest a return or if it's going to grow in value, right? I like that. I like that because it gives us then a different idea of investing.
Yes,
I
that's
think
true.
often we all want to invest in what everybody is investing in. So it's that herd mentality of going with everything that everybody is doing, right? So I like that. I like the fact that you speak about, the paintings.
Yeah.
Classical cars. We've seen people.
The other day, one colleague was telling me about Pokemon cards. Remember Pokemon?
Yes, those tokens.
I was like,
the tokens or the cards?
The cards.
Oh, the ones that you used. Oh,
apparently they have value. And I was like, what?
Of course they've got value.
No, but
people love them.
They love them. Exactly.
Yes.
And apparently I was like, this alternative asset class investments are like, there's a lot.
It's so funny how the law of supply and demand, probably the easiest law in economics is literally through everything we do in life,
definitely.
I like that. Now, you said when you are younger, you obviously are going to assess your risk appetite, but generally when you're younger, because you've got time and you can ride out the market and let the market correct itself, you could potentially look at a bit more riskier asset classes or investment portfolios. Can we really say that the higher the risk, the higher the return?
I think I like to say it in the sense that the higher the risk, the higher the potential return and potential loss. Yes. So a lot of people don't like speaking about the loss that can occur.
Yes.
So we always think high returns equals high risk equals high returns. And that is not always the case. So high risk equals the potential high return, because obviously as an investor you expect to be compensated for the level of risk that you're taking.
Yes.
But it doesn't always guarantee that you will get the high return that you are expecting. So it's important to do your research, back again, going to fundamentals, understanding what your risk appetite is and your ability to take risk. Yes. And your financial situation also speaks to what level of risk you can take. Yes, that's important.
So I'm getting into a Volvo, or I'm getting into what's a fast car? I don't know fast cars. Or a Maserati, a sports car, right?
Yeah.
Leaving Johannesburg, I'm going to Pretoria. So the higher risk car is, of course, the Maserati, hijacking, speeding, could get into an accident. So those are the risks. But I could get to Pretoria quicker before the guy in the Volvo, which is the safest car. Well, that's what they say.
And comfort as well. There is benefits to that. But I think it's just understanding. I think that's and understanding. And also just studying the market as well. I think it's important having the right information around the market and understanding what's happening in the market and what is yielding these high returns and what risks are you taking in relation to the returns that you're expecting.
I like what you said. You said you need to be compensated for the risk that you are willing to take. Let's be fair. Hey, the risk takers, those are the ones that win in life. Have you ever walked past a construction site? Those gentlemen could not be bothered. They're in gum boots. They've got PPE on. They are going to hit on you. Listen.
It's like, and then you're asking, but I've got such respect for them, hey?
Yeah, because I'm
like, this is proper asking to me. But if they win, that's a high return.
That's what you see. And they're compensated for it, right?
Definitely,
I absolutely love that.
I love that.
But of course, it does require a level of knowing the assets that you are investing in and knowing what type of market conditions would affect it, right?
Asset, that's important.
Right. That's quite interesting. So let's talk a little bit about whether or not it's possible to strike a balance of having some of those high risk and then maybe having some balanced, assets and maybe having some low. Is there a way that you can put together an asset allocation, if I may call it that has a balance?
I think it is possible to strike that balance, but I think it's going back to the fundamentals as well, making sure that you diversify your portfolio. Okay. Diversification speaks to having different assets within your portfolio, asset classes, knowing that if one is down, the other one is up as well. So that's important in terms of striking the balance, and also just looking at how you asset allocation in terms of percentages. Yes. So maybe once you're going to 30% into equities, spreading basically your risk as well, and also just making sure that you are informed as well about the different asset classes and what's happening in the market, and researching as well. That's important. And setting your goal. What are you trying to achieve essentially is the most important thing in investments.
And I always find that you know, and we're going to have a conversation with Michael Field about financial education and the value of advice value of financial education and advice. Because often I find that many people generally default to what they know.
Yeah.
So sometimes my asset allocation is not the way it's supposed to look because I actually just know one asset class, which is, let's be fair, many people know property or they think they know property. Let's actually rather say they think they know property. And it's probably the easiest. And let's be fair, if you are going to leverage debt to buy an asset, that's the only asset you can. You can't go to the bank and say, I'm trying to buy 500,000 rand worth of stock, you know? They're not giving you that money, you know? But they'll give it to you for a house, you know? So, and I guess that becomes the easiest. So I know a lot of people that I'll speak to them and they'll say, just buy property. And everybody just thinks, just buy property.
I mean, but I think what I've also seen is that the market has made it easier for people to access the different asset classes. So, I mean, you've got EFTs, you've got mutual funds, you've got...
But where's the money, Nomzamo?
But you don't need that... You don't need a large amount of money. And I think that's where people get it wrong. People always assume I need a lot of money. You can start as little as 100 rands in investing. True. It's about consistency. It's about always doing it like regular investment and being consistent. And giving yourself time.
Yeah.
And it's literally, if you did it over a long... It's like, just set up a debit order. Like, it's money that you probably would have spent eating somewhere or something else. Like, start... You know, make it, once your income comes through, make sure it's something that just goes off without you even thinking about it. But also just go back and review it as well. Yeah. So as much as property is I won't say it's the easiest, it's the obvious because everybody sort of knows it and people sort of think they understand it as well. But there's a level of when you go into property, you can be overly exposed.
I listen, I'm definitely overly exposed. I am. Guys, when I get a lot of money,
like
first
times of COVID, like I had friends who were heavily geared in property. COVID hit. And people, your rentals are not coming. You one of the lucky few, hey?
But you must invest in proper clients also. It's important.
But I think people had proper clients, but I mean, where people lost income, you know?
You see, they don't have good financial planners. You see what my financial planner told me as COVID hit him. He said to me, offer them 1 month of not paying. See, this is what you gotta, but you gotta play the property game.
And also the power of good advice.
Absolutely. You said the magical words. And as you said it, I was like, yes, that's literally what it is. Consistency.
Yeah.
That is compounding.
Yes.
You know, you can't compound without consistency. You read books like Compounding Effect by Darren Hart. You read a book like is it James Clear, Atomic Habits?
Yeah.
That's literally what it talks about. It's just consistency. Everything in life boils down
to being
consistent. And I think that's quite interesting. All right, so let's talk about investor expectations. My people and their expectations.
I love those, right?
What do you guys often find in your space?
I think what we find in our space is that people's expectations
Don't say it.
Like, you know, I think people go in, and I think what drives mostly the wrong expectation is not researching. So you'll find people will go on the website and say, you guys are offering 11 point something annually, and without reading the finer details to say that's at the end of the investment. So people are like, no, this is not what I'm getting. You know, those are the type of things because you haven't researched as well. And people are always looking, like people are always looking for quick wins.
The big win.
I'm gonna say quick wins.
The big win.
Yeah, and you know, so I think that's where you'll find that your expectations do not match your reality. Your expectations don't match what you've put in there because it's unrealistic. Didn't do your research, didn't understand market conditions. You didn't filter in. There's something called standard deviation. You know, the fact that there's a possibility that you will not get what it was told. So your investment can divert.
I don't want to hear things like that, man.
Let's not go there, right?
I don't want to hear things like you might not get what you're expecting. Like I want to get Gosh, I'm such a control freak. Like, you know, I watch movies. I will watch the end of the movie first because I don't want surprises at the end.
You will watch the end of the movie first.
What happens at the end?
Oh, wow.
What happens? If I'm going to watch that movie, I don't want to be anxious throughout the whole movie. There's certain movies I really don't watch. Like there's a new series now, it's called Unseen. It's got Gail Mabalani. I can't watch it until I know how it ends. Like I'm anxious about it. Like everybody's good show, good series, and I'm just like, ay, go at the end. Because I'm such a control freak. And the thing is, I'm the type of investor that needs to know.
So I think that type of investor, it's important for you to set out and do your research. as well.
Because
Understand,
I'll feel spited if I don't get what was told.
So
what
I think,
was told,
So once you sort of understand what investment vehicle you've gone into,
yes,
you do your research, understand past performance. We always say past performance is not always
an indicator,
but it gives you a view. It gives you an indication of how the asset performs, how the asset reacts to market changes. So that's important as well. And also going back as well to your investment goal. What are you hoping to achieve, right?
Yeah.
And that also gives you understanding in terms of your time horizon, because if you know that this is how much I'm expecting and this is what this asset class promises
in 5 years,
5 years, then you sort of understand and you're not anxious because now you know that you've got time on your side as well. And also creating that diversification within your portfolio, that's also very important as well, because
you keep mentioning diversification. Was it Warren Buffett that said people who diversify don't know what they're doing, or am I misquoting him?
I think it would have been him, but I think it's an important it's one of the investment strategies is very important, because I mean if equities like currently, if they're down and you have all your money,
your eggs in the basket,
you are more than anxious. I'm sure you're like panicking. But I mean, if you know, okay, I've got a bit of maybe 40% of my portfolio is sitting in stocks, but I've got other property, and the property market may be starting to pick up, whatever different asset class is performing better, then it buffers.
Absolutely.
Yes.
I saw it with Steinhoff and Breit. I was like, I'm so glad I had Steinhoff when I had it as an individual stock, and then I also had it was part of the top 40.
Yeah, okay.
And I weathered the storm with the top 40, but not in the individual.
So individual stocks are seen more as of a high risk. So because of the fact that
I was like, what is this now?
What is happening right now?
I mean, I think Steinhoff, there was actual issues. Great. It just went in and never came back.
Never saw that one coming.
Listen, and it just never came back. And the thing is, emotionally, and this is the thing I was saying about investing. I'm still holding on.
No.
I still don't know when to.
So that the emotions are important. Like literally, those are also important. Don't invest with emotion.
But how do you not invest with emotion? This is your money. It's your money. How do you take in, I mean, I understand EQ, IQ, whatever, but how do you actually say to an investor, don't be emotionally involved, when you can see it's going red, but at the same time, by the time it goes red, you've lost so much that you're like, let me weather the storm.
It's a tough one. You're right?
Yeah.
Because I mean, this is your hard-earned money.
Yes.
This is your baby. This is whatever. But I think it's also going back, strategy.
Yeah.
What was the strategy?
Yeah.
Time horizon also. Going back to I think reviewing your portfolio is also very important.
Yeah.
Like we spoke about it earlier as well, about making sure that you are looking and understanding the market and what's happening, marketing conditions.
I want to stop you there. Have you ever spoken to a woman who has 3 funeral covers, and you try to explain to them that a funeral cover is an insurance policy? It does not matter how much she's contributed. Yeah, she needs to let go of the 2 because it doesn't really help. The time and money invested, it's so difficult to get them just to understand that.
It is. I won't lie. It is. And I think it also speaks to, like, I think people need to educate themselves about money.
Yeah.
It's important. And I think I'm of the belief that understand how money makes you feel, like the psychology of money and how you relate to money. And I think that's also because a lot of our actions or the way we behave is also based on our exposure to money and how you first came into contact with money, and the people around the people around you, your parents, how they acted around money. And I think that's what creates that attachment to money as well, because I think obviously a lot of people sometimes when you don't have money you also feel a sense of lack, and that's why you want to hold on to it. But I think it's also it's also that, but I always believe sometimes you need to let things go and they'll flow back. But it's also just understanding and being informed, and also understanding that you're taking a risk. There is a level of risk. Yeah. It's not easy. It is not easy. It's definitely not. Like, it's not easy sitting in front of a client and telling them your portfolio has been down for the past, just hold on. Like, I know it's not easy. But it happens. At that point, I'm throwing you with the stapler in the room. But it speaks back to diversification. I like that. And I think you've kind of answered the question of how can investors then set realistic expectation when it comes to investing. I think goal setting was a big thing that you spoke about. Yeah, the goal is important. And I like that because I always say to people,
what did you want your money to do, and did it do it
to achieve?
Yeah.
Yes, and did it do what you?
So what do you think about all of these new asset classes? We've got all sorts of different asset classes. Well, I don't know. I mean, SARS, both SARS and FSCA have declared cryptocurrencies as digital assets and not currencies. So in South Africa, that's what we go. So what's your take on them?
I think they're here to stay, though. Hey, I think it's.
You don't think it's a fluke?
I don't think it's a fluke.
Yeah.
Just given where we are in terms of the world, everything is becoming more digitized.
Yes.
We've got AIs, we've got all these things. So I think it's just one of those asset classes, as we're gonna refer to them now.
Yeah, and they're gonna be part of your mix.
I think they have to form part of your mix because of the fact that they're very volatile, but they've got very great potential for high returns as well.
Absolutely.
So it's important. I think as financial guys, we're a bit wary when they came into the market. We're like, this is unregulated. How would you know this? What are you buying? What is the underlying asset and all these things? But I think it also speaks to researching and reading up about the assets, and just there was a hype where everybody's like, I'm buying Bitcoin. You're not even, so I think it's important just to inform yourself before going into that specific asset class. But I think it should form part of your portfolio.
But then shouldn't the cross then be bared by you guys who are in the financial space, because it's you guys who need to make them safe for people.
Yeah, I think it is.
Yeah, we're moving backwards or in reverse.
So I think it went the opposite way. It's coming back because it came, and obviously it was probably people who weren't in the financial industry.
Yes, absolutely.
And also because of what happened historically in terms of people making things so complicated, exclusivity in terms of all those things are what drove probably the digitization of these assets and the creation of these things, because of the fact that people were trying to run away from financial institutions. But now it's coming back because there is a level of safety and in terms of the rules and regulations and that protect the end user, the investor as well, which is very important in your investments.
Yeah, look, I think that's always been my argument, especially in South Africa. I'll sit in financial planning sessions and people will say, these cryptocurrencies, what is that? And I'm like, guys, in fact, you guys should be leading the conversation
I think it's
around
also just
those.
It's something new. People always, it's not stuff we were taught in. When I was in varsity, there was
be the leaders we expect. All right, now let's talk about how can one drive value out of investing?
I think you can drive value out of your investments through time.
Give it time. Can't take a baby out at 6 months. You gotta give it the full 9 months.
Like we spoke about the avocado tree, planting the seed and giving it time to grow.
But sometimes your avocado tree can grow and it never bears fruit. It will become a big tree.
Then we speak to diversification, so making sure that you've got other, that's how you derive value from. So you'll plant your different, so you might not have your avos, but you might have your oranges, you might have your peaches, you might have your mangoes.
So
that's diversifying your portfolio. That's how you drive. And also ensuring that you've got enough risk-taking assets that potentially will give you the higher return, but you also have balanced assets. So having a bit of a balance within that's what you would assist you in terms of deriving the most value out of your investment.
Mm-hmm. What are the mistakes that you would advise against, investment mistakes that you would advise against, especially for somebody who's starting?
These, I think for me, it's these, if it's too good to be true, then it...
But hold on. If you're not in the financial space, you won't know what is too good to be true.
I think that's the important part, where you do your research.
Okay.
Do your research. Don't fall for these, I won't say scams, but I mean, there's certain unrealistic expectations where people are telling you, just quick schemes. Investments is about
but those
time.
people are convincing,
They are, but
the thing is, when someone is convincing and someone is a trusted, and I'll give you an example. We 2020 hits. We have the lowest interest rate since 1998, and we had a couple of very influential people telling people to buy homes. Right time to buy home. Buy home. Right. The thing is, they are trusted individuals. People will believe them. People run into that and they do it.
Yeah.
And they only do. You know that you only do your due diligence once you're burnt.
I think you spoke about what? Herd mentality.
Absolutely.
So following what the crowd is doing, the next hot things, that's also what gets people into trouble. I think that's what also gets people into trouble.
Hey, Triple M, their hands go up. Hey, WhatsApp, their hands go up. Hey,
people love Ponzi schemes, right? Because of the fact that it's like, no, it's quick wins.
But they also well decorated.
But I think if you go back to what's your goal, what's your time, then that should not, you won't digress too much, because now you know, you're like, if something says within a month you would have tripled your investment, then you're like, but I don't need the money in a month. Also, that means that should be an indication that high risk, high return. And don't put all your eggs in one basket. That also speaks to, don't take money that you can't afford to lose and put it in an investment that potentially has high risk, because it means that the potential for you to lose is also quite high.
Don't you think unemployment is a big issue then? Because I don't see why people would just fall into this quick return thing without having an actual real need for money.
Yeah, I don't think it's greed.
I think we often say it's greed, but I don't think it's greed.
I think you're right in that sense, and we can't ignore the state of the current economy, especially in South Africa, and in terms of unemployment. And I think there's also that desperate need for people to sort of increase their income, you know, and provide for their kids, it is a sad reality. And I think that's why a lot of people fall into these, and you find people who know investments, but I think also depending on the pressure that you're experiencing at the time as an individual, where you're thinking, maybe let me take this and I'll say gamble.
It is a gamble. Anything you do that you don't know is a gamble, guys. Like anything.
But yeah, and I think you're right about that, hey? And I think it's something that it's quite hard to find the balance between the two, because I mean, how do you tell somebody who's unemployed and say, be careful, and you don't fall for the scam? Because here's this person dressed in a suit, driving the car that you hope to drive, telling you to do this, and that's, you know, with the aspirations of becoming like them. So obviously you would fall into that trap as well. So I think it is quite a tough one.
So where's the issue then for pensioners? Because they've worked, they've accumulated the money, but they also are high risk of getting scammed.
So pensioners are high risks of getting scammed.
Because why?
People just like taking advantage of vulnerable people, you know?
They're vulnerable. Why? Is it because they're financially illiterate?
It could, I think it is partly that. But I think there's also an element of, you know,
they're very trusting.
Yeah, like it's, but I always feel sorry for pensioners, hey? Because they are like proper the target for people who are trying to scam people, you know? And I think it's important. If pensioners safe, you're a pensioner, you've worked so hard, make sure that you protect your money. Find somebody who you can trust, you know, and ensure that don't go around just taking advice from anybody, investing in anything. Just make sure, I think, as an old person, have somebody that you trust, and take advice from them, and make sure that you also understand safe.
I did an employee benefit summit in Zambia, and I didn't know that in Zambia you don't have to buy a pension. So you get all of your money. You know how in South Africa the law says give you only
to protect,
1/3.
Yes.
There's no such a thing. They give you a full pension. Go do as you please with it. And they've got stats that show that people don't survive more than 12 months. But they're just not implementing the law.
But I think and I think it goes back to understanding what money is.
Yeah. But also, I mean, let's be fair. These are people that have suppressed dreams throughout their lives. They're taking kids to school. They're trying to make it work. The BMW they wanted, they couldn't buy. And these are some people who probably didn't have more than 100,000 in their bank account.
Yeah, that's what I'm saying. All of a sudden it goes. So it's like it's like a money that you sort of you've never been able to handle. So it just becomes too much, and you don't think it's gonna finish. You don't think it's gonna. You've never seen so much money
on the nail.
It's like
they
it's gonna
don't
be there
think it's gonna finish. And money will disappear on you, eh? Let's get into the next question. What would you say, or where would you say people in their 20s and their 30s should be investing in? What should they look at?
I think they should be looking at retirement products. So I think, especially because of the fact that you've got more time till retirement, so the compounding effect also comes into play. Looking into equities and stocks, which is a little bit seen as high risk at the moment, but I think you have the ability to take the risk because you're still younger. So also looking at crypto, so just striking a balance between having a nice mix of assets within your portfolio as well. But tax-free savings account, I mean, taking advantage of the tax-free savings account, I think that's also important.
Oh, I like that. Yeah. Now, as we've already mentioned, Nomzamo is an investment specialist at a Fedgroup. A Fedgroup is a financial services provider that says it tends to do things a bit differently. Now, on their website, it's cited that the company puts people before profit. And I absolutely loved it because, for me, at the end of the day, if you're working with people's money, they have to also be at the center of where you're putting their money, right? Now, they've got a cute little slogan. I say it's P to the power of 3. It's people, planet, and profits. And I can tell you that they really, really believe in that because at Can Agri, one of the products that you guys were talking about is your endowment.
Yes.
So tell us a little bit about that new offering.
So we recently launched our Impact Endowment. It's basically a normal endowment. But the nice and the exciting thing are the assets within the endowment. So we've got in our impact farming assets. So we've got 2 funds within the Smart Agri Fund that form part of our endowment. So that's the new product that we've launched. So it's got all the rules of an endowment, but I think it's the underlying assets that it invests in, which is actually what. So it's obviously, like we said, it was Can Agri. So those are some of the farms. We've got blueberries, solar panels. So it's speaking back to people, making sure that those farms are also employing the people within those communities. So that's the product that we've launched here at Fedgroup.
So essentially, the underlying assets, you guys have moved away from the likes of your equities, your real estate, your bonds.
So it's
cash equivalents. You guys have gone food. You guys have gone those
solar. So we've gone
assets that build.
Yes.
So they have a social impact.
Yes. So we've got a little bit of commercial property within the fund as well. Smart Agri. So we've got your So it's asset classes that are not your usual your equity stocks and stuff, but these are they're not governed by what happens in the market.
Yes.
So it's quite an amazing product, I must say, and I love the fact that it's tangible assets that you can see. So I mean, you spoke about the planet as well. So it's Smart Agri. So making sure that you're using less water, using solar as opposed to electricity. So those are the type of assets that make up the fund.
Sure, Nomzamo, you've been absolutely fantastic. I think we will cap it here for today. But if you remember anything from what Nomzamo said, 1 is get educated. 2, make sure you set realistic expectation when it comes to your investments. 3, start as early as possible because you have time on your side. And if anything, that is probably the magical portion that you need, or potion rather, that you need. It is time. And most importantly, make sure that you do diversify. Now, Nomzamo, thank you very much.
Thank you so much, Nicolette, for having me. It's been absolutely a pleasure. I was a bit nervous when I started, but it went by so fast.
And you were absolutely fantastic. And that's why we pride in having conversations with people that live what they talk about. You don't want to speak to somebody that kind of tatazela with the conversation. You don't know. Does this one know what they're talking about? But, and I think that's what we owe to our listener, somebody that really lives it, understands it. And I guess as an investment specialist, that's literally who you are. Yeah. Now to our listener, thank you very much for tuning in to Yes, Money Does Matter. Remember to join Financial Bunny TV on YouTube for more personal finance conversations. And I will catch you guys on the next one.